Hello all, I am going to discuss about impact of 125 bps repo rate cut in year 2025 in this video. So let's begin. The first and foremost impact is yield may ease. So interest and yield both denote return for investors. So with the reduction in interest rate, yield will also ease. But there are some other factors also which affected yield during the year 2025. So let's discuss those other factors one by one. Yield spiked because of first reason is the US India yield gap that has been increasing. At present, it is around 250 bps in December, which was 189 bps in June 2025. So the widening has been increasing on account of depreciating rupee. Since the rupee has been depreciating, the foreign investors they demand higher yield to negate the adverse impact of currency risk. Since they are investing in rupee denominated GSEC yield, so if the rupee depreciates, the value of their investment will also come down. So they want to uh, balance it while demanding higher yield, considering the possibility of further depreciation in rupee. So yield may soften again if the rupee stabilizes. And secondly, if you know the US tariff uncertainty has been there since 27th of August 2025, a tariff of 50% has been imposed on India, which had adverse impact on the Indian exports. So that global turmoil or headwind has been there for the Indian economy. Because of that, yields are rising. Then GST rationalization had a fiscal impact because of that. The investors were of suspicious that the fiscal deficit may not be made, and because of that, they demanded higher yield. And then a steady supply of GSEC is there, which is outpacing the demand. So these are the external factor, other factors which resulted in spike in yield. So what were the factors because of which yield is? Those factors are India's sovereign rating upgraded from triple B minus to triple B by S&P. So this was done in August 2025, and repo rate cut was there since Feb to June. Repo rate cut was 1%, and recently in December MPC meeting, further reduction of 25 bps was there. And then the benign inflation. The inflation is all-time low in October 2025. It was 0.25%, which is all-time low since the inception of this CPI series. So this also helped in easing out of yield. So these are the factors. Because of that, yield was affected. Other than if you say other than the repo rate factor. So in May, your GSEC yield was 6.28. In June, it became 6.37%. July, it was around 6.3. In August, it was 6.50%. So if you see from July to August, there has been a jump of 20 BPS. So it was mainly on account of two reasons, and that we have already discussed. The first reason was GST rationalization. In on 15th of August, our honorable Prime Minister announced for GST rationalization. So because of that, that was the first thing which impacted the yield adversely. And secondly, the US tariff imposition, it was affected since with effect from 27th of August. Though there was a good thing that India's rating upgraded from triple B minus to triple B from the yield perspective, I'm saying. So because of that, yield is, but net to net, there was an increase of 20 BPS from July to August. So that was a major hit from the perspective of yield. In Feb, if you see, the yield was around 6.70%. So as of now, yield is hovering around 6.53 or 6.52%. So there has been improvement from that reference period. Now coming to the other impact, the price of financial assets move up in the secondary market. There has been an inverse relationship between the yield and prices. So if the yield goes up, price will go down. If the yield goes down, the price will go up. So since the interests are coming down, yields are coming down. So price of those financial assets like the GSEC yield is there. The banks they have invested in SLR securities, which are government securities. So when the yield goes down, the price of government security will go up in the secondary market. So if you sell it, then there will be directly you will book the gain. Even if you don't sell it, there will be valuation gain, or you can call it mark to market gains. So it is good from that investment perspective if you are already having that holding. Though there will be lower demand for bonds because the yields are coming down, so for the newly issued securities there may be less demand. The demand for loan will increase since your EMIs, they are linked to say external benchmark, that is repo rate, and mostly in case of retail or MSME that is the case. So your EMIs will come down, or because of that, demand for loan will increase, and as a result cost of capital for businesses that will also come down if they have taken some MSME loans. And but at the same time, the return on asset, that also will come down. Say you have deposited some money in the bank, so bank will have to reduce their rate on deposit offered by them, because otherwise it will have a negative impact on their net interest margin. And coming to the rupee part, the rupee will strengthen if you go by the interest rate parity theorem, but that will happen in only longer run. But in short run, rupee will depreciate as foreign investors they will invest in economies which are giving better returns. So these are the major direct impact because of the repo rate cut. What will happen from economic or banking perspective? Now, what are the concerns for banks? Let us discuss them. The first and foremost is concern is the rate cut is transmitted faster in debt instrument than the bank loans, because 45% of your bank loans they are repo rate or direct external benchmark linked. Remaining 55% is MCLR, wherein the transmission takes place. It may take up to a quarter or 4 months. So because of that, the corporate they will move to debt securities, because therein yields are coming down, so their pricing is directly linked to GC yields. So corporate will nudge that part. So as was being desired by the bond market participant, and to ensure transfer, the RBI also acted preemptively in this monetary policy committee of 2025 on the liquidity front by announcing a 1 trillion OMO purchases. Means they will infuse that much of liquidity in the market, and $5 billion buy sell swap for December. So this way they will nudge the yield. So for the clarity, RBI indicated that the OMO is only for to infuse some durable liquidity in the system, and is not to be construed as a yield signal, but it is going to impact the yield directly. So means better transmission will help in the capital market, but for bank loans it will take some time, especially your MCLR linked loan. There is also clarity from the RBI that the operative rate for the system will be WACR, and the RBI will continue with its daily liquidity management to ensure that WACR hugs the repo rate. For a more detailed clarification, you may refer one of my videos on this, that is liquidity management by RBI. I'll keep that link in the description part. Now, debt securities they are also immune to rising yield in future. Once you issue the debt securities, then even in the future, if the yield rise, the issuer will not be in pain. It is the investor who need to bear that loss. So issuer are immune to that. But that is not in the case of bank loans, because pricing gets reset. And the third point is asset side repricing is faster than the liability side repricing, because in 45% of your loan book is external benchmark linked or repo linked. So immediately that benefit will be passed on to the borrower. But for on the deposit front, on the liability front, you cannot reduce the rate of deposit immediately. It will take some time. So for the time being, your NIM will get a hit. But here we need to note that there will be a short-term hit on NIM, but the margin pressure is moderated with lower CRR requirement, because CRR requirement that has been lowered from 4% to 3%. Now, some of the concepts are there, that there is an inverse relationship between price and interest or yield. So for that also I have created a video, or link of that I will keep in the description part. Now coming to the Keynesian theory on this price and bond relation, and the demand for loan or cash. So let's discuss that first. As per the general theory of employment, interest and money published in 1936, it is the choice between money and bonds. If the agents expect the future nominal interest rate or the rate of bond to be lower, than the current rate, then they will reduce their holding in money and increase their holding of bond. Means it means they are going to invest in bonds in future. They are going to invest in bonds because in future your bond yield is coming down. Means in future you will be able to sell those bonds, or even if you don't sell it, you will be able to book valuation gains. So that will be the right time for an investor to invest in the bond when they expect that the in future yields are going to. Monetary policy generally cuts policy rate to support growth. Now, as per Keynesian theory, the demand for money will be more because the rate has been cut, and investment in bond will be made only when the yield goes up in future. So this is the time theoretically the lowering interest, it should increase the demand for funds. So theoretically this has been the proposition which has been given by the Keynes, but borrowing is always for some particular purposes. If it is for running a business, uh, through what is called a working capital, it lowers the cost of capital and it improves your business metrics. But it does not make sense to borrow more for investment in a situation of surplus capacity or lower demand. Means credit demand will be subdued only because economy as a whole is not in the dire need of liquidity because there is no economic activities are around. So this situation is called liquidity trap, where the demand for money remains fixed no matter how the central banks increases the money supply. This means that even if the interest rates were lowered or to close to zero, there would be no demand for credit. So it is more of a demand side, aggregate demand side issue. It is not a supply side issue. So this situation is called a liquidity trap. But in this MPC of December 2025, it has been stated that with the credit growth on the rise and with capacity utilization high, the RBI finds some indications of private investments gaining ground. The assessment of the RBI is that external uncertainties can pose some risk to growth, but with domestic growth chugging along well, the overall growth prospects are better. This is adequately acknowledged with a 50 bps increase in the growth estimate for financial year 2026, which has been enhanced from 6.8% to 7.3% now. I hope this you will find this video a good giving a good understanding on some of the basic financial or economic concepts. Thank you.